While preparing the final accounts of a trading concern, in question he gives one trial balance and below the trial balance he gives some adjustments. In ledger we prepare personal accounts, real accounts and nominal accounts. Now all those accounts names one by one he gives in the trial balance, and if that account shows a debit balance, then in debit column amount will be given. If that account shows a credit balance, then in credit column amount will be given. To prepare final accounts, these trial balance rules you should keep in mind. So in debit column what we record? Assets, expenses, losses, drawings. And in credit column we record opposite to this: liabilities, incomes, gains, capital, reserve, fund, provision. Okay, what is mean by adjustment and which type of adjustments will be given in final accounts? Regarding this topic I made another video. That video link I am giving in the description box. Watch that video also. Okay, and with these two informations we have to prepare final accounts of a trading concern. And trading concern final accounts include trading account, profit and loss account and balance sheet. So first we will see about trading account and profit and loss account. Final accounts of a trading concern contains three things now: trading account, profit and loss account and balance sheet. So trading account and profit and loss account both we prepare in one table only. Now see the heading for these two accounts: trading account and profit and loss account of dash. In question he gives owner's name. That owner's name or firm's name we have to mention here. For the year ended 31st December 2018. You know that we prepare final accounts at the end of the year. So if end of the year is 31st December, then what is the starting date? 1st January 2018. So current year is 2018 year and this firm is following calendar year as their accounting period. That is why it is starting from 1st January 18 and ending with 31st December 2018. So on 31st December 2018 we are preparing final accounts. Nothing but trading account, profit and loss account and balance sheet. Okay, trading account, profit and loss account, these two accounts are nominal accounts. So what is nominal account rule? Debit all expenses and losses, credit all incomes and gains. According to nominal account rule, all expenses and losses we are writing in debit side, incomes and gains we are writing in credit side. Then you know these expenses are of two types: direct expenses, indirect expenses. So direct expenses we are writing in trading account debit side, indirect expenses we are writing in P&L account debit side. What is direct expenditure, what is indirect expenditure, in detail I explained previously. Then come to credit. These incomes are also two types now: direct income, indirect income. So direct income is only one, sales. We record that in trading account credit side, and indirect incomes we credit to P&L account. And why he has given for the year ended, you should know. For example, in trading account debit side we wrote purchases, some amount, no? Take one imaginary amount, say 50,000 rupees. What is the meaning of this? From where this 50,000 came? Before final accounts, on 31st December 2018, we prepared trial balance. In trial balance, purchases value is 50,000 in debit column. So that 50,000 we take in trading account debit side. Now from where we got this 50,000? Before this trial balance, we prepare ledger book now. In ledger, we prepared purchase account. In purchase account, from 1st January 18 to 31st December 18, whenever we purchase, all those purchase figures we debited to purchase account. Cash purchases, credit purchases, everything we wrote in this account. And at the end of the accounting period, in purchase account, how much is the balancing figure? 50,000 rupees. That 50,000 we take to trial balance, and from there it goes in final accounts. So this 50,000 figure is from 1st January 18 to 31st December 2018. How many purchases we made? All those purchases total is this 50,000 rupees. Therefore, this sentence is used for the year ended. So it gives the meaning that whatever values we are writing in trading account and P&L account, all these values represent 2018 period. So all these values are nothing but the consolidated figures of 1st January 18 to 31st December 2018. So remember, trading account and profit and loss account, these two represent the values of a particular period. These are not the values of a particular date. Therefore, we use for the year ended sentence. Trading account, profit and loss account. Observe, we are adding account word to these two statements. So these two are basically accounts. Now recollect ledger account format. When you prepare ledger, account contains, any account contains two sides, debit side, credit side, and each side we open date column, particulars column, journal folio number column, and amount. Now trading account, P&L account are also accounts only, but we are not opening any date column and journal folio number columns here. Why? Because in case of ordinary ledger account, day-wise transactions we enter in the respective account. But in case of trading account and P&L account, total year consolidated figures we are writing now, and these two accounts when we are preparing at the end of the year. So again date column you need not to mention. Since these two are accounts, two sides we have to put DR and CR symbols. Trading concerns prepare trading account, profit and loss account and balance sheet. Now, why they prepare trading account? Trade means what? Purchasing and selling. And trading concern engage in that activity only. They buy final products from suppliers. By adding some profit, they sell them to customers. Now, this is the main activity for a trading concern. In that main activity, whether they got profit or loss, to know about that, they prepare trading account. So, in trading account, all expenses we are debiting and all incomes we are crediting. So the difference between income and expenditure is known as gross profit or gross loss. For example, credit side total is 50,000 rupees and debit side total is 40,000 rupees. Then the difference 10,000 is what? Credit side we wrote incomes, debit side we wrote expenses. Since income is more than the expenditure, the difference is called gross profit. We said we should write that. Which side total is less, that side. So debit side to gross profit 10,000 we have to write. Then two side total will be credit total 50,000, 50,000. Suppose debit total is 50,000 and credit total is 40,000. So what happened here? expenditure is more than the income, then the result is called gross loss, where it appears credit total is less. So credit side by gross loss 10,000. Now two sides debit total 50,000, 50,000 we have to write. So remember, either gross profit or gross loss, any one value comes to us as an answer. Observe this word gross profit. Why gross word we used? Because this is not the final profit which can be taken by the owner. So only in main activity of the concern, how much profit or loss we earn, we are showing here. To this profit, indirect incomes we have to add, and from this profit, indirect expenses we have to deduct. Then the final figure, which is called net profit or net loss. This is the final result of that business. So owner is going to take this net profit amount only, not this gross profit amount. So you may get one doubt. When owner is going to take only this net amount, net profit, then why we are calculating profit in two stages? So gross profit, net profit, both why we are calculating? Can't we write all direct, indirect expenses in debit, direct, indirect incomes in credit? And can't we directly calculate net profit or net loss? No. Because why we calculate profit in two stages? For this there are some reasons. If you directly calculate net profit, you cannot know whether your sales are up to the mark or not. Similarly, you cannot know whether you have a proper control on indirect expenses or not. With one example, I will explain this point. Gross profit figure is 1 lakh rupees. Then this 1 lakh we take to P&L account credit side now. 1 lakh rupees. Assume there are no indirect incomes, only indirect expenses are there. Say indirect expenditure amount is 2,000 rupees and net profit figure is 98,000. So there is no much difference between gross profit and net profit. What is the meaning of that? We have a proper control on indirect expenses. Take another example. Assume gross profit amount is 5,000 rupees and this indirect expenditure total is 2,000 rupees. Then 5,000 minus 2,000. How much is the net profit? 3,000. And according to the owner, this 3,000 is very less amount. He is not satisfied with the 3,000 rupees profit. What is the reason for this less profit? Are we not maintaining proper control on indirect expenses? No. Indirect expenditure amount is only 2,000 rupees. The 2,000 difference between gross profit and net profit is acceptable. Where the problem is, gross profit is less. Why gross profit is less? Because sales amount is less. So owner should not concentrate on controlling the indirect expenses. Owner should think how we are to increase the sales amount. Take other example. Say gross profit amount is 50,000 rupees. We are taken here 50,000. No indirect income, only indirect expenditure is there, and the indirect expenditure is 45,000 rupees. Then how much will be the net profit? Only 5,000. And the owner is not happy with this figure. So what is the reason here? We have good sales, but the problem is we are not having proper control on indirect expenditure. Now owner should concentrate on how to control the expenses. Like that, if gross profit and net profit separately if you calculate, then you can analyze the financial performance in this manner. Whether we have to concentrate on improving the sales or we have to concentrate on controlling the indirect expenses. Where the problem is, we can easily identify. For that sake, we have to calculate profit in two stages. And the second reason is, after preparing final accounts, based on the final accounts results, we calculate so many ratios. Among them, gross profit ratio is one important ratio. What is the formula for this ratio? Gross profit ratio is equal to gross profit divided by net sales into 100. What is meant by net sale? Cash sale plus credit sale minus sales return is equal to net sale. Now, if gross profit percentage is more, then the meaning is the operating performance of the firm is satisfactory. So, to judge that, we calculate gross profit ratio, and to calculate gross profit ratio, we need a gross profit. Therefore, profit is to be calculated in two stages. This is the second reason for calculating the profit in two stages. First, we will see trading account. Observe the debit side. Trading account we started with opening stock. What is the meaning of opening stock? Our current year is 1st January 2018 to 31st December 2018. Opening stock means the unsold stock left over at the end of previous year becomes opening stock for current year. What is the previous year? 1st January 2017 to 31st December 2017. Suppose on this date, closing stock, nothing but unsold stock of previous year at the end of the date is assume 5,000 rupees. This 5,000 stock we have to carry forward to current year, no? In current year, on opening date, we have to bring this closing stock. Now for current year, this stock becomes opening stock 5,000 rupees. So with that value, we have to start trading account. Suppose it is a new firm. Is there any previous year to that? No. Is there any unsold stock of previous year? No. In that case, opening stock will not be given in the question. And where he gives this opening stock, it will be available in the trial balance. After writing opening stock, we have to write purchases. If opening stock is not sufficient to run the business, then in current year, firm may purchase extra goods. That purchases you have to debit to trading account. Regularly, firm purchases goods and rarely firm purchases fixed assets. Which purchases we should take here? Only goods purchases we should take. If any fixed asset is purchased, it is a capital expenditure. Capital expenditure appears on asset side of balance sheet. No, don't write that purchases in trading account debit side. We may purchase these goods for cash or on credit basis. Two types of purchases we should write here. After purchasing these goods, if owner withdraws any goods for his personal use, then in inner column from purchases we have to deduct that drawings. Similarly, if any consignment purchases are included in this, we have to deduct that. If purchase amount includes goods purchased on sale or return basis, then that purchases also we should deduct from purchases. And goods we purchased, but goods are in transit, not yet received by us. In that case, we should not record these goods here. We have to show them in balance sheet asset side as goods in transit. Sometimes we may receive purchase invoice but not the goods. In that case, these goods we should not include in purchases and we should not include in this closing stock also. When you are writing purchases, you have to observe whether any purchase returns are given in the question. In trial balance, purchase amount will be given in debit column and the purchase returns amount will be given in the credit column. When you are writing purchases in debit side of trading account, you have to observe whether any purchase returns are given in the question or not. If purchase returns are not given, then this purchase amount directly we have to write in outer column. If purchase returns are given in the question, then take purchases in inner column, deduct purchase returns, and the net purchases you have to write in outer column. For purchase returns, he may use different words. Sometimes clearly he gives in the trial balance, purchase returns. But sometimes he gives like this, returns outwards. Returns outward means what? Goods are returned and after returns goods are going from the firm. When they go like that, once we purchase that good and now we are returning, then only goods go like this. Therefore, whenever returns outward is given, then the meaning is it is purchase return. Sometimes he gives like this, returns credit balance. What is the meaning of this? Returns credit balance means purchase returns. Why? For purchase returns, what is the journal entry? One should recollect. For example, goods are returned to Raju. Entry will be Raju account debtor to purchase returns. Assume amount is 1000. Then in purchase returns account, which side we have to post this? On credit side, because purchase returns are credited. So credit side by Raju 1000. And if this is only the transaction, then which side balance carried down comes? Debit side, and that balance is called a credit balance. So remember, when return credit balance is given, then the meaning is it is a purchase return. Otherwise, in trial balance, he may give like this, only return word and the amount in credit column. Which returns he give in credit column? Purchase returns. In that manner also you can identify. After writing these two, you can write other direct expenses. What are direct expenses and which expenses come under direct expenses? Clearly I explained. Then come to credit side. Credit side we have to write sales. These sales include cash sale and credit sale. And regularly firm sell goods and rarely firm sell fixed asset. So which sale we have to credit to trading account? Only the goods which we sold on cash basis or credit basis. If a fixed asset is sold in balance sheet from concerned asset, you have to deduct that. You should not write in trading account. While writing sales amount, keep some important points in mind. If goods are sold on consignment basis, then from these sales we have to deduct that consignment sale. And we sold goods, but goods are not yet dispatched. Even this sale also you can credit to trading account. In trial balance, if only sales are given, then write down sales amount directly in outer column. But if trial balance includes sales returns, then take sales amount in inner column, deduct sales returns, and the net sale only we have to write in outer column. Now, how he can give these sales returns? Sometimes directly he gives that word, sales returns. Sometimes he may give this word, returns inward. Means what? Goods are returned and after these returns, goods are coming into the firm. When they come like that, once we sold these goods to customer, now customer is returning to us. So goods are coming. Therefore, when return inwards are given, then the meaning is these are sales returns. Sometimes he may give sales returns like this, returns debit balance. Then it is called sales return. Why? One should recollect the entry for sales returns. For example, goods returned from Murali. What is the entry? Sales returns account debtor to Murali account. Say amount is 500 rupees. In sales returns account, Which side you have to post this entry? Debit side to Murali 500. If this is only the transaction, then where balance carried down comes? On credit side 500. This balance is known as debit balance. No? Whenever returns debit balance is given, then the meaning of that is sales returns. Suppose in trial balance he has given like this. Sales income, now always he gives in credit column and returns amount in debit column. He is not clearly stating whether it is purchase return or sales return. In that case, you have to observe in which column he is giving the amount. When the amount is given in the debit column, then understand that it is sales return. Next item on credit side is closing stock. So we started trading account with opening stock now. Therefore, we have to close the trading account with closing stock. Closing stock means what? Observe, on when we are preparing final accounts? On 31st December 2018. No? If this is the closing date of current year, the stock which is left over on that particular date is known as closing stock. So on 1st January 2018, we had some opening stock. In current year, we purchased some more goods, and in current year, we sold some goods out of them, and finally, we are left over with some goods. Then these leftover goods are known as closing stock. When you start trading account with the opening stock, it is correct to close the trading account with closing stock. So these two are nothing but opening balance and closing balance of any ledger account. One should recollect ledger account. For example, Ravi account we are preparing, and there is some opening balance, debit balance. Then what we do? On debit side we write to balance brought down some amount. In that particular month, whatever transactions take between Ravi and firm, we record on debit side and on credit side. Finally, assume that debit balance is coming. Then what we do? Credit side we record it. How? By writing balance carried down, and we close this account. An ordinary ledger account is opened with opening balance and closed with closing balance. No? Similarly, in case of trading account, we open it with the opening stock and we close this account with closing stock. Whatever we are recording in trading account, same thing we can express in the form of one formula also. What is the formula? Gross profit is equal to sales minus cost of goods sold. Okay? If a sales amount is more than the cost of goods sold, then it is called gross profit. If cost of goods sold amount is more than the sales amount, then the answer is called gross loss. Now, how we calculate this cost of goods sold? For that also there is one formula. Cost of goods sold is equal to opening stock plus net purchases plus direct expenses minus closing stock. Okay? To understand this formula, take some imaginary values here. Assume that opening stock amount is 5,000 rupees, net purchase amount is 8,000, direct expenses 4,000 rupees, net sale amount is 20,000 and closing stock amount is 5,000. Then how to calculate cost of goods sold? Opening stock 5,000 plus net purchases. Net purchase means what? Cash purchase and credit purchase of goods minus returns is called net purchases. Net purchase value is 8,000 rupees plus direct expenses total is 4,000 minus closing stock value 5,000. Then 5 plus 4, 9 plus 8, 17,000 minus 5,000. Cost of goods sold is equal how much? 12,000 rupees. Now, how we get gross profit? Sales amount is 20,000 minus cost of goods sold is 12,000. Then gross profit amount is 8,000 rupees. In account form also you will get the same result. Observe. Credit total is more now. Credit total is 25,000 rupees. Write down the same amount. 25,000 minus 17,000 is equal 8,000 rupees. Opening stock value will be given in the trial balance now, but generally closing stock will be given as an adjustment amount. Why? Because we don't prepare any closing stock account in ledger book. So how to calculate closing stock value? At the end of the year, accountant goes to firm's factory, go down and showroom. There physically he verifies the quantity of goods. And how to calculate the cost price of this closing stock? Other values from ledger account we are writing. But for closing stock there is no account now. Then how to know the value of this closing stock? For that there is a separate lesson known as inventory valuation. To calculate the cost price of closing stock, we have so many methods like FIFO method, first in first out method, LIFO method, last in first out method, or average method, weighted average method. So by using one appropriate method, accountant calculates the cost price of closing stock. And closing stock comes under current asset now. So to show the current asset values in the books, we have to follow conservatism convention. Conservatism or prudence. What this convention says? While writing the current asset values in the books, cost price or net present value, nothing but market price. Whichever is less, that value is to be recorded in the books. So, for example, we calculated the cost price of this closing stock. Assume it is 10,000 rupees. And the market value on this particular date in outside market, how much is the value of this stock? Say 12,000 rupees. Cost price is less. Therefore, here closing stock value is to be recorded as 10,000 rupees. If market price is 8,000, then don't show the cost price here. Closing stock value is to be recorded at market price 8,000 rupees. So remember, closing stock will be given in the adjustment amount 2 times we have to record now. Once we have to credit to trading account, and second time in balance sheet asset side we have to show this. Sometimes closing stock and opening stock both will be adjusted through purchases. In that case, closing stock will be given in the trial balance. If closing stock is given in the trial balance, then don't show that closing stock in trading account. Only in balance sheet asset side we have to show the closing stock. Regarding opening stock and closing stock, you may get one doubt. That is, trading account is a nominal account now. So nominal account rule is debit all expenses, losses, credit all incomes and gains. As purchases or expenses, we are debiting to trading account. No doubt will come. And as a sale is an income, we are crediting to trading account. But in case of opening stock and closing stock, the doubt is these two are assets now. Why assets are shown in a nominal account? So observe this example. One firm is preparing trading account on 31st December 2018. Means their current year is a calendar year, starts from 1st January 18, ends with 31st December 18. Now they prepared one trading account, and to understand this point, not only the amount, even quantity also I am mentioning. Assume that on opening date, they have 100 boxes with them, and each box cost price is 10 rupees. Then opening stock value is 100 boxes into 10 rupees, 1000 rupees. And in current year, they purchased 50 boxes. And the purchase price is per one box 10 rupees. Then two purchases 50 into 10, 500. For our convenience, we are not taking direct expenses here. Assume there are no direct expenses in that particular year. And so how many boxes are there with us? 100 plus 50, 150 boxes. During the year, firm sold 80 boxes at the rate of 12 rupees each. Cost price is 10 rupees. So they don't sell for cost price only, they sell for more than cost price. Assume that they sold for 12. On one box, there is a profit of 2 rupees now. In that manner, they sold. So sales amount is 80 boxes into 12, 960 rupees. Now, out of 150 boxes, if 80 boxes are sold, then how many boxes are remaining with us? 70 boxes. So on 31st December 2018, closing stock quantity is 70 boxes. At what rate we have to calculate closing stock? You know, cost price or market price, which is less. Assume that cost price of each box is 10 rupees and market price of each box is 13 rupees. Then which price we take here? Cost price only. So 70 boxes at the rate of 10 rupees, closing stock value is 700. And your doubt is, opening stock and closing stock both are assets. So assets we should not write in trading account because trading account is a nominal account. In that case, without considering these two, if you imagine trading account, then which meaning it gives? Observe. Say this 1000 rupees not there, this 700 rupees not there. In that case, even though we have 100 boxes on starting date of the year, we are not writing that in the trading account. So in current year, we purchased 50 boxes at the rate of 10 rupees each. Purchase is an expenditure. So according to nominal account rule, this purchase amount we debited to trading account. And sales amount is 960. So according to nominal account rule, income we have to write in credit now. So 960 also we wrote. But closing stock we didn't write. So imagine trading account now. Debit side we have only 500. Credit side we have only 960 rupees. In that case, how much will be the gross profit? 960 minus 500 is equal to 460 rupees. Is it the correct amount? Correct gross profit is 160. So, according to your books, gross profit is not correct. And the other wrong meaning also it gives. What is that? If you have only 50 boxes with you, how can you sell 80 boxes? Then the meaning is 50 boxes are sold for 960 rupees. But how many boxes are sold for 960? 80 boxes, no? Clear? And physically if you observe, with you how many boxes are there? 100. Already we have on the opening date, and again we purchased 50. So 150 boxes. Out of this 150, 80 boxes we sold. And physically if you observe, in your go down 70 boxes are there. But according to trading account, 50 boxes we purchased and 50 boxes we sold at the rate of 960. Now there is no closing stock. Then assume that for next year we are preparing accounts. Next year 2019, how many boxes are there with us? 70 boxes, no? These 70 boxes we sell. Then in 2019 sales amount we credit to trading account. But assume in 2019 there are no extra purchases. Opening stock is 70, purchases are nil, and these 70 boxes we sold. But since closing stock we are not writing here, in next year opening stock also we should not write. So it gives the meaning that for 2019 year, without having any goods, we sold goods to customers. We didn't purchase anything and there is no opening stock, but we sold 70 boxes to customers. So this many wrong meanings it gives. That is why we have to write opening stock and closing stock in trading account. And while writing these two values, we are following matching concept. What matching concept says? In 1 year, when you are writing incomes in the accounts, to earn that income, how much expenditure you incurred, that expenditure also you have to show in that particular year only. Therefore, in 2018 year, we sold 80 boxes at the rate of 12 rupees. Okay, and out of these 80 boxes, in current year, how many boxes we purchased? 50 boxes. And 30 boxes when we purchased last year, no? When 80 boxes income we are showing here, then 80 boxes related expenditure you have to show in debit side. If you don't record opening stock in debit, then what is the meaning of this? 80 boxes income we are crediting to trading account, but 50 boxes expenditure only are debiting to trading account. Are you following matching concept? No. This is also the reason for showing opening stock and closing stock in trading account. Now come to second account, that is profit and loss account. If there is any gross profit in trading account, we have to bring that to credit side of P&L account. And if there is any gross loss, then bring it to debit side. So gross profit or gross loss, any one amount you have to write in P&L account. After that, debit includes all indirect expenses, no? So indirect expenses are of 7 types. Administrative expenses, selling expenses, distribution, finance, maintenance. About all these expenses, already I have explained to you. Similarly, if there is any indirect income in trial balance, then you have to credit that indirect income in profit and loss account. After recording all these amounts, we have to balance profit and loss account. Suppose credit total is 80,000 rupees and debit total is 30,000 rupees. Then the difference 50,000 is net profit, because credit side we wrote incomes, debit side we wrote expenses. When income is more than the expenditure, then the result is called net profit. Now that net profit on debit side we have to write 50,000 rupees, and two side total will be credit total 80,000, 80,000. This net profit we have to add to owner's capital in balance sheet. Suppose credit total is less than debit total. Debit total is say 50,000 and credit total is 30,000. Then the difference 20,000 is what? Net loss, because expenses are more than incomes. In that case, credit side we have to write that net loss 20,000 and two side total will be debit total 50,000 and 50,000 rupees. If there is any net loss in balance sheet from capital, we have to deduct. So in P&L account, either net profit or net loss will be the answers.